Jeff Rowe.
Here.
Ed Bradford.
Here.
Jermaine Sullivan.
Here, sorry.
Doug Parks.
Here.
Bill Gamble.
Here.
All right. We're all set.
Old business, Hound Resource royalties.
So there was the report I put in the packet. We've gotten about $5,700 so far this year. We're monitoring that because there was a sale to Asher Oil. We just want to make sure that transition, there's no hiccups in payments being received, so we'll keep an eye on that.
Okay. Approval of minutes from August 2nd, 2024.
So moved. Support.
All in favor?
Aye.
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 Opposed? Okay, passed.
Advisor update and commentary.
We're ready for you.
He's on mute.
Whenever you're ready, Woody, we're ready for you.
Okay, thanks, Kelly. Brian, are you here?
There he is.
Okay, well, I think everybody has the materials. Oh, here he is. Okay. Sorry, I was make sure we had the whole team here. So, yeah, so if you go to page 4, these are some of the highlights, and I think I'll simplify with some kind of overarching comments and then turn it over to Brian to go maybe touch on a few of the charts. But, you know, years ago, this doesn't happen very often, but it was referred to, this is kind of like a Goldilocks economy, which markets love when it's not too hot, not too cold. And we have really a marvelous set of, you know, factors going with this right now. We have low unemployment. We have low inflation, fairly low inflation. And we have low interest rates. And we have an economy that's still growing, and corporate profits are going up. And so this is kind of like the best of all worlds. And, you know, we've certainly seen the results of that in the stock market. That's not to say there's not areas of caution, because any of those can shift at any point in time. But generally, you know, we have a very good, economic environment in which to invest. And with that, I'll turn it over to, maybe I'll turn it over to Troy first and see if Troy wants to add to that.
Only to just, state the obvious. We're all hearing about the Fed has kind of switched its policies now towards lightening up on the interest rates. And so 50 basis point hike, a few weeks ago. And now the market, with some recent strong economic data, was thinking another 50 basis points, but now maybe just 25 basis points at the next cut. So softening a little bit there on the, how aggressive the Fed might be right out of the chute. But definitely, the numbers, that we have an inflation slide here on page 5 if you want to kind of move to that real quick. But you can see where the numbers have come down quite a bit as we've moved through the last, 18 months. And definitely getting closer to the Fed's ultimate goal of 2%. You look under the hood at the inflation, and it's things like consumer services that still have some inflation in them, and also homeowners equivalent rents. So housing is still, showing some inflation, but most of the other sectors are in decline. So seeing quite a bit of improvement there on the inflation front.
Brian?
Yeah, it's maybe interesting to point out, we came out there in early August, but if you look on page 6, and maybe Troy, I'll have you add some comments on this as well, but the last quarter we saw a pretty dramatic change in interest rates across the board. And so if you're on page 6, you can see the blue line is where interest rates were for treasuries at the end of the second quarter, and then the line below, that's where we ended up in the third quarter. And if you look at the 1-month treasury on the left side, at the end of June that was yielding 5.5%, and that's come down to 4.9. That reflects the Fed's 50 basis point cut in September, but it impacted longer term bonds as well, and that's really a reflection of inflation improving meaningfully since June, and we've had further good readings since we met in early August, and so really a pretty dramatic move lower in bonds, and for one quarter.
Brian,
And
do you
then-
want to take just a minute and expand on how this chart works?
Brian, are you able to share your screen? We did have a request when we record the meeting. Are you able to show that?
Sure. Yeah. Okay. Can you see the
Yes.
Yes.
the chart interest rates decreased? Okay. Yeah. So that Woody asked to explain this a little bit further. So the left side is the prevailing yield for the bonds, and then on the lower axis here is the maturity date for Treasury. So it ranges from a 1 month. Kind of the key ones to pay attention to is, I would say, a 2-year Treasury and a 10-year Treasury. The 10-year Treasury has a big impact on mortgage rates, all sorts of borrowing rates, and so we saw that decrease from 4.5% down to 3.8%. So, and we've seen that reflected in, still somewhat high mortgage rates, but much lower than they had been, say, a year ago, and in other borrowing rates as well. So that'll help at the margin. Home buyers, small businesses that are borrowing, say financing inventory or what have you. So that should have a positive impact on the economy. Any questions on that page? Just point out a couple other, I think, interesting charts here in our economic section. So if you flip ahead to the next page, 7, this just looks at historically how markets, the S&P 500, have performed in the first year after the Fed cuts interest rates. And so we go back all the way to the late 20s and looking at different rate hike cycles. And generally, I believe the average return for the S&P in the first 12 months is around 13% up after the first rate cut. Now, there's 2 outliers there, which happen to be more recent outcomes, which were in January of 2001. Of course, we had 9/11 later that year, and then September of 2007. Beginning in March of 2008, we had the Great Financial Crisis, of course. So, this isn't a huge sample size, but it does go to show that by and large, markets have been able to perform pretty well after the first rate hike. And we talked about this in August, but it's probably become even more significant on page 8. Just looking at valuations of, again, just the S&P 500. We've seen valuations creep up even a little bit higher in the last couple of months, just given the performance here, especially in September. So the valuation of the S&P 500 has crept up to 21.5 times earnings for the next year. And down at the bottom, we point out the top 10 stocks, much of those being kind of large tech stocks that we've talked about multiple times. The earnings for those are significantly above the market average of about 30.5 times earnings. Importantly, we saw the other parts of the market really perform well in the last quarter and here in October. And so that's increased from about 16 and a half earnings to 18 and a half times earnings, and reflecting the outperformance there. But, those, by and large, outside of the top 10, the market looks fairly reasonably valued. It's just some of the larger companies that are driving the higher valuation for the market overall. And I should have mentioned the long-term average is right around 17 times earnings. And then one last one, page 11, since we have the election coming up here in a few weeks, thought it may be interesting to share a chart just on how U.S. stocks have performed under different political outcomes. And I think the only thing I'll point out here is on the left side, you can see the two columns here. Markets typically have performed best when you have a split between the Senate and the House, and it doesn't matter so much which party the president is. So gridlock has tended historically to be good for markets. It's harder to get significant legislation through, and businesses therefore can kind of better plan what the rules of the game are. So just thought it'd be interesting to point that out since we're right in the middle of election season.
Any questions on any of the charts? We didn't talk on to all of them, but maybe anybody in the room has a question on some of the other charts or the ones we did talk about. Okay. Well, we'd like to take a few moments and talk about a special topic, which is the U.S. debt levels, and more specifically, U.S. government federal debt in the U.S. This is a very disturbing development. Is Ed with us today, Kelly? I couldn't tell from the roll call. I couldn't hear.
Yes,
I'm here, Woody.
Okay, good. Because the reason I brought that up is I know Ed is from time to time asks questions about this, so I know it's something that he's concerned about. But it's something that the general public kind of ignores, and it has not yet become a factor in market conditions because people just aren't concerned, and other investors, mostly governments around the world, continue to be very happy buying our government bonds as we run these big deficits. So until there's kind of a buyer's strike, around the world, and the dollar drops in value, this becomes more of a theoretical issue or a hypothetical issue, but it's a bothersome one. And Brian will talk about some of the charts in a moment, but there's a kind of, to put a little more weight or seriousness behind this argument, is there's an historian that's well known. His name is Neil Ferguson, and he's written extensively about over the last 500 or 600 years, there's been 4 great superpowers in the world. We had Spain, we had the Ottoman Empire, we had France, and then of course the British Empire before America became the kind of the predominant power in the world up until 1947. It was the British Empire. And in all 4 of those cases, once the interest on the government debt exceeded the defense budget, those empires went into decline. And as of next year, we're going to have interest on our debt exceeds our defense budget. So there's a lot of disturbing things that could develop over time, mostly because it's probably inflationary, as governments have to print more money to pay off debts. It tends to be inflationary, but as of now, it's not really a problem. But Brian's put together some good charts here that goes into a little more detail about kind of the severity of this situation.
So Brian, somehow your charts we're not seeing all of them when you're sharing your screen. It looks like there's like a second window up or something.
maybe you expanded it, Brian, or something. Expand it?
No,
But no, I think
it's,
you-
it's like too big.
Too-
We're not seeing the whole thing on the screen.
Oh, okay.
It was
Let me go
fine
back
up
to-
until just a few minutes ago. I'm not sure what happened.
Okay. Is that better?
No.
It
Nope.
didn't really do anything.
No? Any better?
Can you move it, Brian, over to the left?
Let's see.
Sometimes stop sharing, restart works. I feel like it's frozen.
Yeah, it seems like it might be frozen. Maybe stop sharing and then, because it's on your
Okay.
PDF document, but it's got 2 windows on it.
Okay. Let's try it again. Sorry, we typically use Zoom, so I'm not as adept at Teams.
That's good.
There you go.
Okay. All right. Apologize for that. So, that'd be, we talked about the budget deficit and kind of spending levels the last time, and I thought it may be helpful just to put some charts together to kind of visually, help talk about this. But, what is the federal surplus or deficit? So it's simply how much the federal government is spending, more than the income that they're taking in through various tax revenue sources. And of course, all else being equal, if you are running a deficit and in today's dollars, it looks really large, but it's more instructive to look at it as what percent of GDP, what percent of our deficit of the economy is it? And so you can see this shows what percent of the surplus or deficit that we're running versus GDP going all the way back to the 30s. And you can see we're running about a 6% deficit. I think the economy today is around $23 trillion annually. So that, means we're running well in excess of $1 trillion in deficits currently. And I think it's, we've only ran a surplus for a brief period in the late 90s. So, it's not atypical to be running a deficit, but it's, I think it is, from this chart, instructive to see how large of a deficit that we're actually running. And this is during an economy that's actually growing. So you can see there's been more recent spikes where it's been higher during 2020. That was during the COVID shutdown. And then back in the great financial crisis in the 08 and 09, kind of more recently. But these are very large deficit levels for, especially when we're have a good economy and, low unemployment at 4.1%. So it's very concerning to us, probably more of not a short-term problem, but more of a medium to long-term issue, and what that means for what the government will be forced to pay for interest rates is, I think investors over time will demand more interest as our credit worthiness is seen as not as good as it once was. The next chart shows, just to help read this, this is the federal debt level. This line here, and so this shows what percent of GDP we have in overall debt. So before we were talking about current year spending, surplus or deficit, but this is how much debt we actually owe. And so you can see really a huge spike starting around 08 and 09, and there was a lot of spending around that time to get us out of that severe recession, but it's really never come back down. And then we had another huge spike during the COVID time period. So, at this point we have close to 100% of debt relative to annual GDP, which I said was around 23 trillion. And then maybe even more importantly, what percent of our government expenditures are going towards servicing this debt, paying the debt. And for, even though we saw this huge spike, I'll kind of focus on the last 15 years. Even though we saw this huge spike in debt in 08 and 09, as I said, we really didn't see an increase in how much we were spending on interest, because even though we were spending more on interest, the economy was growing during this entire time period. And importantly, interest rates were really low for the last 15 years until 2022 when they started to pick up. And then that's why we started to see interest payments as a percentage of government spending increase very significantly in the last couple of years, because we have all this outstanding debt and now interest rates are higher, so that the treasuries, when we're rolling over, issuing new treasury bonds, well, we need to pay kind of what the prevailing interest rates are. So what is that doing? It's crowding out spending for other things and also causing the deficit to become larger. So I thought it'd be helpful just to kind of put it in perspective of, how much are we actually spending on interest, and, what percentage of overall federal spending is this. And so this is an updated number through August. And you can see net interest on our debt has crested up to 13% of federal spending. And it's actually a little bit higher than defense spending at this point. And it's the third biggest category after Social Security and right behind Medicare. So it'd be helpful to kind of put a little bit more, put some data behind it, and just highlight that, this is really becoming quite an issue, and something that will need to be addressed in the future.
Troy, would you want to comment and kind of make this germane to the Manistee oil and gas portfolio, kind of what investment implication there might be for this kind of matter?
Yeah, I think the thing to keep in mind is as the government has to issue more and more debt, at some point those interest rates might need to go higher to absorb all that debt. And so rising interest rates, especially on longer term debt, can be risky in a bond portfolio. So especially on the longer bonds beyond 10 years, but especially 30-year bonds, those could have pretty dramatic negative performance if interest rates rise. And that's one reason why we tend to focus on the intermediate maturity bonds. And I guess the other thing just to mention is, the Treasury curve that Brian went through earlier, if those interest rates go higher, everything we finance kind of sets off the Treasury curve. So all corporate bonds are sort of priced based on where Treasury rates are. So if Treasury rates go higher, so do corporate bond rates. They have to go higher too. And so it has implications for everything. And so it just kind of puts this, this is an important topic, and it's just not getting a lot of headlines right now, but at some point it could.
Brian, you said that your closing statement was, well, we'll have to address this in the future. And I can see people back in 1940 saying, yep, we're going to have to address this in the future. And it never gets addressed. And it just continues to grow and grow and grow and grow and grow and become a problem. I don't see this problem getting addressed. And at some point, what do the market, I mean, it's going to have to be the markets that enforce that discipline. What does that look like if it comes to that point?
Well, I think what happens, Ed, is at some point, this is not a problem because there's a ready market to buy the U.S. government bonds to finance these deficits. And so, all over the world, when people have extra cash, they put it in the U.S. government bonds because they think it's safe. But at a certain point, and it may have been we've already kind of hit that inflection point, because the U.S. government debt is not really a pure AAA bond anymore. It's not, for forever, most of our lifetime, it was a high quality bond. But now the rating agencies, they know that the obligations
that are in place for the government make the debt not AAA. And if that was to be, if there were less ready buyers of our debt around the world, which has actually already started to happen, but in a very slow way, then our interest rates will go up, the dollar will go down, and eventually the general public will, demand either a balanced budget or something will have to be done because inflation will get out of control, and it'll force some of the things I think you're talking about, Ed. But we don't know. I mean, that could be next year. It could be 10 years from now. I think it's I think it's inevitable, but it's just a matter of when. Does that help?
No, that was helpful, thank you. Congress might need to get Dave Ramsey to talk to him.
They
Yeah.
might not listen.
Yeah.
Elon's gonna take care of it all.
Well, why don't we move forward into the portfolio, and on page 17, you see here a snapshot of the portfolio, and as of September 30th, we've done a little rebalancing, so the equities are not at that 67.9% today. They're a little closer to the 65%. But you can see the portfolio value, $14.3 million. We're widely diversified along the lines of the investment policy statement, which is where we get that target allocation column that comes from the investment policy statement. And the next page shows kind of how we manage the bond portfolio, and I'll let Troy make a few comments here.
Yeah, thanks, Woody. This is the part of the portfolio that's exclusively for the bonds, and the portfolio is in the lighter green color there. And the couple bond indexes are in the darker blues. The table in the upper right-hand corner really has the important metrics there. The average maturity, a little over 4 years. Again, that's made up of bond portfolio holding bonds that mature primarily between 1 and 10 years, with pretty much an emphasis on the bonds inside of 5 years, really. And then the yield of 438 on the portfolio at the end of September, that's down from when we reported 3 or 4 months ago when interest rates were higher. So it's coming down with the general level of interest rates, but still pretty good if you go back over the last 10 years, that's still a pretty good yield on the bond portfolio. Not that long ago, we were struggling to find bonds that had 2% yields, and that hasn't been that many years ago. So really not too bad here. And then the A+ rating indicates good quality across the board there, and that's shown in the lower right-hand table there. Any questions on how the bond portfolio is positioned, diversified?
So Woody, that looks like we're probably at maybe the highest level of government bonds that we've had in quite some time. Is that just because the treasuries were reflecting the Fed's hikes, and you're balancing that as opposed to the corporate bonds?
And the extra yield that corporate bonds pay over treasuries has gotten less and less.
Okay.
I don't have a chart on that book right now, but a year ago it was substantially better, and it's getting less attractive. It's sitting close to the all-time low for that extra yield. It's called the spread over the treasury, and that spread has diminished. A treasury can perform pretty well against a corporate bond when that corporate bond doesn't have as much extra yield. So the other reason for, kind of leaning into some treasuries is, while it's not on the front burner that we're going to have a recession, the economy had been slowing down, and, it's not certain that we're completely out of the woods yet, but, it looks like the Fed has engineered a pretty soft landing so far. But if things were to tip over, the treasuries would still be very helpful in their performance versus, say, corporates.
Another way of looking at that is Troy is basically saying is that corporate bonds are overvalued because investors are very optimistic about the economy, and we're not being compensated appropriately for that higher risk of a corporate bond relative to history compared to a government bond. So that's why Troy and his team have been increasing the government bonds. Just another way of looking at it. Any other questions? Brian, you want to kind of give an overview of the equity sectors?
Yeah, thanks, Woody. So page 19 has the equity sector allocation breakdown. And yeah, the dark blue line or blue bars are the portfolio, and we showed the S&P 500 and the lighter gray bars as a comparison. I'll just point you to the top that technology sector continues to be the largest allocation within the Manistee portfolio at 23.5%. Significantly below where the S&P is in terms of technology weighting at almost 32%. And that's, by design, being cautious in terms of the valuations and earnings expectations in that sector, and kind of avoiding some of the more highly priced names. And, I think being good fiduciaries and finding good opportunities in other areas. One of those areas that we see a lot of opportunity in is healthcare, and that's one of our more meaningful overweights. We've started to see earnings pick up in other areas outside of technology in a significant way in the second quarter, where healthcare earnings actually led the market in terms of year-over-year return or earnings growth at around 20%. And earnings are expected to broaden out here in the third and fourth quarters. And we're still very early in earnings season, but we're starting to see that come to fruition. So healthcare is one area that the stocks really haven't performed all that well up until the last couple months. And so as we saw, we think the valuations are pretty attractive in areas outside of technology. And if earnings materialize, we think that'll be good for the portfolio overall.
I think most of you are familiar with this. Was there a question?
No.
No.
Okay, so this is the cash flow going back historically back to when we started, which was March of 2009. And you can see the fund balances, the oil and gas royalties, and then the distributions for the capital budget. You can see that we've now distributed almost $7 million in total over that 5-year period. And it's good to see where back in 2009, we were only, I think there was some distortions there, Ed, those 2009 and 10, but, we were distributing around $300,000, and now we're up, approaching $450,000, which is kind of a nice growth rate in the distribution over the years. And we hope to, see that continue to grow to fund projects for Manistee. Any questions on the cash flow additions and distributions? And then the performance on page 22, you can see going back over the years, the average net of all expenses about 7.5%. And more recently, because of the very, very strong market, we typically underperform during strong markets because we try and preserve capital and moderate the volatility in the market. And but the last year has been quite nice. We're up 23% over the last year, that trailing 1-year column. And then you can see the other
um, performance periods there too. Any questions on the performance?
We like up markets.
The trend is your friend.
As long as it's up.
Yeah.
So Woody, just kind of circling back on inflation, the last article I saw in the Wall Street Journal, last numbers said they were still running hotter than what the Fed had expected. So you expect them to pump the brakes on the rate increases or just do quarter point systematic increases?
Well, I think people have been surprised how strong the economy is, and employment stayed pretty strong. Consumer spending has stayed pretty strong, and so I think lowering the rates, too aggressively will just fan maybe too much inflation. And so, to your point, I think the Federal Reserve is a little more cautious than they were a month or two ago because they don't want to, bring inflation back. It's kind of a tightrope, but it seems like from what Troy tells us that over the last few weeks, economic indicators are coming in fairly healthy. And so, maybe you don't need to lower interest rates much more, as aggressively as we thought a month ago.
I mean, don't you think they want to keep some powder in the keg in case we do tip to a recession in 6 months or something?
Yeah, I think that's true. You could, again, going back to the deficit, one of the ways to stimulate the economy is to spend a lot of money. Well, if you're already borrowed up pretty much, you got to rely on cutting interest rates, maybe even more. So to be able to bring that as a tool, if they gradually bring rates down for no real strong reason, it kind of diminishes their toolkit. So yeah, I think it probably says unless they see a dramatic slowdown, I could see where they would want to slow down and maybe just do 25 basis point cuts for a while and kind of watch the data and make sure things are moving along okay.
Are they still unwinding their huge quantitative easing holdings kind of on a systematic basis, or have they paused that?
I think they're pausing that, and I think that happened back in May or June. And so what that means is they're not letting that debt mature as much and roll off. So I think it's gone a little bit sideways.
Brian, did you want to talk about that chart? Oh, okay. Sorry. Any other thoughts, comments, observations?
Brian looks like he wants to say something.
It's muted.
I think you're on mute. Right.
Look, it went way up, and it's higher than it was back in 19.
Yeah, so this is the Fed balance sheet. So it has been declining still as they kind of let maturities roll off. Just to answer your question, it was as high as 8.9 trillion, and it's around 7 today.
So basically, they're at the same spot they were when they started getting aggressive right after COVID, right? Because they almost doubled it from 4.2 to 7, and they really haven't gone back to those pre-COVID levels.
Correct. Mm-hmm.
Anybody else got any more questions?
All right, I think we're all set, guys. Thank you.
Thank you.
Thanks for the update.
Thanks, everybody. Thank you, Kelly.
Thanks, everybody.
Have a great
Appreciate
day,
it.
everybody.
Thank you.
Okay, meeting dates for 2025. We have January 17th, April 18th, July 18th, and October 17th. Everybody good with that?
Yeah.
Do we need to take roll on that? I don't.
We do.
Okay.
You just have to, yeah. We need a motion to accept the dates. Okay.
I'll make a motion.
Support.
Okay. All in favor?
Aye.
Okay. Opposed? Motion passed.
Okay. Other public comment? We don't have anybody, so motion to adjourn.
Move on.